bonus, depreciation, and cost segregation explained clearly. Hello and welcome back. Thank you for joining us for episode 3 of this series. In the previous episode, we talked about how real estate can generate income while also reducing taxes. Today, we are going to explain two terms that often sound complicated but are actually very practical: bonus depreciation and cost segregation. Let's start with cost segregation. When a property is purchased, the cost is usually depreciated slowly over many years. Cost segregation simply breaks that property into different parts. Some parts can be depreciated faster because they wear out sooner. This allows more deductions earlier instead of spreading them evenly over decades. Now, let's talk about bonus depreciation. Bonus depreciation allows certain portions of those costs to be deducted immediately instead of waiting many years. This does not mean the property is losing value. It is a timing benefit created by the tax rules. Together, these tools can significantly reduce taxable income in the early years of ownership. That is why they are so powerful. But they are not always the right choice. These strategies make the most sense when there is sufficient income to offset and when the property is expected to be held for the long term. Used incorrectly or without planning, they can create confusion or future tax surprises. The key idea is this: bonus depreciation and cost segregation are planning tools, not shortcuts. In the next episode, we will discuss how to use real estate losses the right way. We will cover passive rules, material participation, and how to avoid costly mistakes. Thank you for watching, and I will see you in episode 4.